Could you address what role, if any, you think the Fed's decision to raise rates has played in the slowdown we are now seeing?
Well, let me just say the Labor Market Conditions Index is a kind of experimental research product that's a summary measure of many different indicators. And essentially, that measure tries to assess the change in labor market conditions. As I look at it, and as that index looks at things, the state of the labor market is still healthy, but there's been something of a loss of momentum. The 200,000 jobs a month we saw, for example, in the first quarter of the year, that's slowed in recent months. Exactly what the reasons are for that slowing, it's difficult to say. It may turn out, again, we should never pay too much attention to, for example, one job market report. There's a large error around that. We often see large revisions. We should not overblow the significance of one data point, especially when other indicators of the labor market are still flashing green. Initial claims for unemployment insurance remain low. Perceptions of the labor market remain fine. Data from the JOLTS on job openings continue to reach new highs. So there's a good deal of incoming data that does signal continued progress and strength in the labor market. But as I say, it does bear watching. So the committee doesn't feel and doesn't expect, and I don't expect, that labor market progress in the labor market has come to an end. We have tried to make clear to the public, and through our actions and through the revisions you have seen over time in the dot plot, that we do not have a fixed plan for raising rates over time. We look at incoming data and are prepared to adjust our views to keep the economy on track. And in light of that data dependence of our policy, I really don't think that a single rate increase of 25 basis points in December has had much significance for the outlook, and we will continue to adjust our thinking in light of incoming data in whatever direction is appropriate.